Hello and thank you everyone for joining us on this presentation today. My name is Steve Tuttle and I'm a partner here at Signet Financial Management. I'm also the Chief Investment Officer of Fixed Income. Here's some quick disclosures for you to read on this presentation. I'm going to start with a quote from a famous investor that I think is particularly relevant today. It states that bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. I think this is particularly relevant because it really gets to the heart of how emotions can drive markets on the upside and the downside. If I were looking from a totally unbiased point of view right now, which I always try to do, I'd say we're somewhere between skepticism and optimism. I don't see us in a state of euphoria where I might begin to get worried. That being said, it's a very common question that we receive from clients and even just people on the street about, are we about to enter a bear market? Is the bull market a little old and about to end? And I think there's four good reasons why that may not be the case. For one, investors, while they might be complacent, I don't think there's excessively positive sentiment out there. So that's a good thing. The economy is strong across the globe. Corporate earnings are right on track for another very strong quarter, particularly in the technology sector. And finally, Fed policy still seems very supportive for stocks going forward. So where does that leave us? Well, we think we're somewhere between the mid to late cycle phase of the business cycle. We see that the global economy is improving, and with that brings a very low risk of recession. In terms of implications, we believe stocks look attractive relative to bonds. That hasn't changed in our minds. Rising asset prices and valuations could limit upside from here. So that's a little bit of a risk. We think it's important to diversify, given where we are in the market cycle, to diversify and possibly offset higher volatility or temporary or short-term gyrations in the marketplace. And finally, we think it's important to be active in this phase and search for ways to improve returns. And one way we can do that is to look back at history and to see historically how have different sectors and asset classes performed in the mid-cycle and late cycle phase. And what we see is that the mid-cycle tends to favor riskier asset classes, while late cycles have performed, we've seen a little bit more mixed performance. And typically what does well in the late cycle are inflation-resistant assets, such as cyclical stocks, shorter duration bonds, treasury inflation-protected securities, commodities, those types of asset classes. So if we're right about where we are in the business cycle, while we're still in the mid-cycle, you should continue to see asset classes performing well, particularly stocks. And then as the markets move on, you might start to see a little bit more mixed results, but still positive on the stock side. And we think it could be important to emphasize, again, inflation-resistant asset classes. We've talked quite a bit over the last few years about the importance of owning foreign stocks in addition to U.S. stocks. And historically, when investors think about foreign stocks, the conversation usually shifts towards large cap stocks or emerging market stocks. And we think there's another sector that warrants attention, and that's small caps. Just like in the U.S., foreign markets have large caps and small caps. And if you look at the dynamics of international small caps from a historical point of view, the risk reward seems to be pretty attractive. They tend to return a little bit more than large caps, with just a little bit more risk and are even look attractive relative to emerging markets. So that's an area that we think does belong in a properly diversified portfolio. For taxable investors, I want to emphasize that municipal bonds have continued to perform pretty well and add value in portfolios. And if you look at municipal bonds compared to taxable treasury bonds, the yield currently a little bit higher on an after-tax basis, and the risk historically has actually been a little bit lower. So that's a nice combination that we like to hear and position our portfolios accordingly. So I'm going to end just with a few final thoughts on how we are positioning portfolios today and some things to think about. The first is it may be a good time to turn off the autopilot, and that's a simple way of saying it's important to be more thoughtful and selective about investing today and to pay careful attention to valuation. In the mid to late cycle of the marketplace, it's more important not to just blindly invest in an index. There are going to be more winners and losers out there, in our opinion, and an active approach and a flexible approach should become increasingly more important. The other thing is that you might be overweight equities and underweight fixed income. With stocks going through a long, I think we're on year 9 of the bull market, your portfolio might be a little bit riskier than you intend. So I think it's important that you view it from that perspective and consider rebalancing or realigning the relationship between stocks and bonds in your portfolio. You don't want the portfolio to take on more risk than you need. And finally, emphasize sectors and asset classes that should fare best in this environment. I emphasized earlier how foreign markets may be in a different place than the U.S. Perhaps the U.S. is a little ahead of foreign markets currently, but because of that, foreign markets might have a little bit more upside from here. And inflation-resistant sectors such as cyclical stocks and treasury inflation-protected securities, even commodities, are areas that we're increasingly looking at. So if you have any questions on any of the topics we brought up today, or if you just want to talk about your portfolio, I'd encourage you to give me a call or send me an email. I'm always available. And I'd also encourage you to follow us on Twitter. We have a really nice stream of articles and insights that I think could add value to our relationship. So with that, I want to thank you and have a good day.